Boom.
Boom, it
Ladies
is.
and gentlemen, my name is Judah Hoover. This guy right over here is Josh Weidman. I am a real estate investor and a realtor. Josh is a real estate investor and a hard money lender. He wants to give you
That's
all
right.
the money you need to buy and sell real estate, and I want to help you buy and sell real estate. I did 30, 25 transactions last year, 27 transactions, something like that. And my goal is to do 50 this year. Josh wants to lend a whole bunch of money, and we love helping people with real estate, whether it's for our profit or not. Whether we just
Yep.
help you and it benefits you, great. If we end up getting a deal out of it, we do a deal together, that's great too. And because of that, that's kind of where this show came from. This is the Build and Grow with Real Estate show, where we teach people how to be real estate investors, how to be, junior partners into syndication, senior partners into syndication, how to, buy mobile homes or lend on mobile homes, how to buy, fix, and sell, whatever your stripe of real estate investing is. We want to talk about that. We also want to talk about what things look like when it comes to servicing the real estate community. So we think
Yep.
the real estate industry is a great way to make a living. We also think it's a great place to build wealth. And we talk about all those things here on the Build and Grow with Real Estate show.
Awesome. Yeah. So since last week, Judah wasn't here. Had a friend of mine on the program who has a ministry out of Lebanon. I thought that was a really good show. And then I start getting spammed. Your sister starts texting me and Facebooking me saying, "Where the heck are you? There's so many people in this meetup group that like they're just pouring out of the place." And of course, I'm in a wrestling match, and you are raining down the knowledge. I heard that
Yeah,
the meetup was
it was
great.
absolutely phenomenal. I run a local real estate investors club called the Landlords Investors Mastermind Group. We meet the fourth Thursday of every month. Josh is a huge help there, and one of my knowledge providers. I try to bring together a whole bunch of people who are looking to help each other out, and Josh is definitely one of those people, and he's normally there. But last week we had 168 people in the room. That counts the two babies. My business partner Chad says I can't count the babies. Gabe, a new employee who's running up our Pittsburgh operation, he thinks I get credit for one of the the babies count as half.
Yeah.
So
Hey.
I don't know how that works. I counted souls in the room.
Well,
So there's
I love it.
168 souls in
That's
the
right.
room.
Well, so I'm going to tease something for your next meeting.
Yeah.
I talked to a potential borrower yesterday, and this happens a lot in both of our businesses. Well, I'll get a call for a loan, and I start talking to the person and realize that they're going to be better off either selling the place, or they need a long-term financing, or they need something that we don't provide. And a lot of times, I mean, shoot, I've been doing this a long time. I've sold a bunch of houses. I've flipped a bunch of houses, all that kind of stuff. I'm still hiring Judah to list a property in 2 weeks.
Right.
That I'm flipping. I'm not going to try to do it myself. We try to find the experts, the people that are really know the business, and point them in that direction. But here's the teaser. Next, at the next Lancaster Investor Mastermind Group Harrisburg event, which is going to be the third Thursday of
Fourth Thursday of the month.
fourth Thursday. Oh man, okay.
All right.
Bottom line is, here's the deal. I got a woman coming with a newly rehabbed 5-bedroom house that is tenant occupied, that she wants to sell for about $40,000 under market value, under
Nice.
retail value. And she's going to be at the meeting next Thursday to present it to investors. So, hey,
Yeah.
look, if you're looking at buying a nice rehab property at, below market value at a 20%, 30% discount, stop by. Anyway.
Yeah, we'll definitely help her make that happen.
That's right.
Good
That's
stuff.
right. So, all right. Today's topic is kind of interesting, and it's pretty timely. We've been chirping back and forth about raising interest rates for the last 2 years. Since we started doing the show. But I'll tell you what. Now we're actually seeing it happen. We've seen about I don't know, just about a 1% increase over the past year from January to January. Right now, the interest rates are sitting still at really great, really great rates. But
Historically, amazing rates.
I mean, yeah,
I'm gonna
exactly.
punch in the face the first person who complains about a 4% interest rate on their primary
Well,
residence.
and it's not even. It's 3.5 on a primary, and it's like
Right.
four
When
and
it
a
when it by
quarter,
the
four
time
and
it
a
gets up to
half on.
4%, there's gonna be people complaining, and I
Oh,
am going to punch them in their face.
that's right. That's right.
I
Um,
remember listen, this is how, you talk to older people and I remember when, like, getting people 7% was a good thing. When I got
yeah.
started in, like, the early 2000s. Good, Josh, I'm glad you backed up your slides there because I was just about ready to tell you that, if you're not careful there, you're gonna show the wrong slides. Yeah,
That's
but
right.
what is it? Well, it's like 3.98% today is like,
Hold on
no,
here.
no, no, no,
Hold
no,
on there.
that's
It's
even too
not.
high. What did I say? I
It's
like
like 3.54 or 55. We'll look at it. We'll look at it. All right. So let's just pull up these slides. Let's jump in here to content, because I think this is super important, and I think it's one of those things that we gotta examine. I wanted to start the conversation by giving some context, right? Right here, about 40, it's 48 years worth of historic information on the average interest rate on a 30-year fixed mortgage. So as we look through this, I mean, it's pretty remarkable. We started in 1974 with, 9.19%. And as you scan through these, it spikes up to 16.63% average for the year in 1981.
Yeah, and it's not like it was there for, just a little bit of time.
It's two
Throughout the
years.
entire 80s,
Yeah.
you're talking about 10% interest at least
Yeah.
for your primary residence, 10% in interest every year. It's just crazy.
Well, and, here's what's really interesting, and what I thought was kind of interesting. This is a pretty good illustration of inflation. I mean, it's like, yes. Yeah, well, hold on. We're gonna hold that thought to the next slide, right? But a couple things that I wanted to point out here, and what you notice is that we had this high eights and 9% that really led to the end of the Jimmy Carter presidency. I mean, it was a big contributing factor, and
Yep.
then the 80s we spike, and for essentially the whole Reagan presidency into the Bush presidency, we have these interest rates that are double digits. I mean, and it's really remarkable to look back and see this, because we had a lot of economic growth during this time. But what we also had was, you know, a lot of inflation in the early 80s that the government was trying to get under control. And so that's one of the reasons I think that we saw this big spike in interest rates for so long.
Yeah, there was also a lot of what was called negative gearing that was going on at the time, where there was people who were buying properties specifically to lose money on the property so that they could write off huge taxes, and the government was trying to incentivize this and change up that and do a bunch of different things.
Sure.
And the more the government fiddled with things, the more things got out of whack. And listen, to whatever else you want to say about Reagan, the biggest thing that Reagan did, he gets credit for tax cuts, but really what Reagan did is he just said, "Listen, we're just going to simplify the tax code.
Sure.
We're gonna come in and we're gonna do this is how the taxes are gonna be, and we're gonna do away with a whole bunch of deductions." And unfortunately, even though in a lot of ways that righted the ship, it short term threw some things out of balance. And in order to rein in inflation, they had to really spike interest rates for a short amount of time,
Judah,
and then they were able to slow that down.
it's like I stepped on your foot or something when I start talking about Reagan and high
Yeah,
interest rates. It's like,
yeah, yeah,
man,
yeah. I got yeah, yeah, yeah. I try.
it's not a personal attack.
I
It
was
just
I was
is.
I was trying to be as
I got it. It's
nonpartisan,
okay.
as I could about that. I might have a son, named after Ronald Reagan, so, like,
Okay.
personal
Well,
hero of mine, yes.
all right. So let's just look though at where these rates are. I mean, and if we look historically, look, the only reason that the 30-year fixed rate mortgage matters, or what the rate matters, is because of the cost of money, right? And as you see here, as the cost of money has gone down, housing prices have gone up quite a bit,
Right.
and so let's take a look at the cost per 100,000 borrowed for a 30-year fixed mortgage over the decades, right? And I broke this into the 70s, 80s, and kind of broke it out more recently. But I mean, you look at this, and in the 80s, we got a 12.7% average interest rate. If you're borrowing $100,000 at 12.7%, that's $1,082.80 a month. And for the first 15 years, you're paying off the interest. You're not making a huge impact on that principal. So, that's a humongous difference from $452.91 per 100,000 borrowed that we're seeing today. Or that we saw. Yeah, I mean that we're seeing today. If you get a 30-year fixed this month, right? Today, and you go out and get a quote, you're looking at 3.569%. That's the annual percentage rate. So these spikes have a lot to do with the value of money, right? Even though the interest rate was much higher in the 1980s, you might have been paying $20,000 or $25,000 for that house that today you're paying $200,000 for. And so a lot of this has to do with access to capital. And so, like, as the interest rates drop, the cost of money drops, and so the access to that capital is a lot more widespread. And so you have a lot more people borrowing the money, buying houses, and it's
The deal
probably a
doesn't
good
have to
thing.
be as strong if the borrowing costs are lower. Just like the deal doesn't
Right.
have to be as strong. Think of it this way: the deal doesn't have to be as strong y- if the taxes on it were cut in half.
Hmm.
So if you're saying, oh, I want to buy this house, it rents for $1,000 a month, and I can buy it for $100,000. Well, think of that same house, but instead of the taxes costing $2,500 a year, if they were only $800 a year, because it was someplace, it was in a slightly different area. Well, then you're
Hmm.
saying, well, geez, because of that, I'm willing to pay 105,000 for that or 110,000 for that. You
Yeah.
can so the costs affect what you're willing to pay for something. And
Is
when
it-
interest rates mean that the cost of borrowing money is cheaper, you're willing to pay more for it. You're
a couple
seeing this
years
right
ago.
now, and we're seeing this right now in other places. The other two big examples that I always try to use is talk to your parents about what it was to buy a car.
Right.
And there was a time when it was expected that you paid cash for a car. Now it's expected that you have a car payment, but there was a time that was expected that you paid cash for a car, and therefore you bought and sold cars based on the sticker price, not based on the
Monthly
payment.
payment.
Now we buy and sell cars based on what the payment is, and anybody who works in the car business will tell you they just have to get the payment right.
Yeah.
For us, another good example is college. Look at what's happened with college. It's just exploded because in the past 5 to 10 years, really 10 to 15 years, there's been a lot more avenues of students taking on debt, and student debt has become a much bigger thing, and that's really made it easier to finance college, and therefore colleges haven't had to worry about keeping their prices down because people can just borrow the money.
Well, I
Same
remember
thing.
when. Well,
Same thing.
so I remember when I was in college, the interest rates were so low for student loans that the conventional wisdom was you never pay off your student loan.
Right.
It's $80 a month. It's nothing. Well, now people have hundreds and hundreds of thousands of dollars of loans, and they're not at 30-year fixed mortgage rates. They're at like 6, 8%, and I
Yeah.
mean it's a mess. But anyway, that's a totally different show.
Yeah. No, but it talking about housing, talking about cars, and talking about real estate, or talking about student loans, they all kind of come together, and
Sure.
and you can see how the price of something, the price of the underlying purchase, is affected by the ease of finance.
Yeah. Yeah.
And ease of finance is expressed in, and the cost of finance is expressed in two different ways. The underwriting principles, how tight or how loose they are, and we're going to talk about one of those examples here in a second, and the cost, and that's what we're expressing right here with these interest rates. As interest rates go up, it becomes harder and harder to finance, and I don't think that it is going to pop the housing bubble or collapse the housing market. I think that it is going to slowly ease and put the brakes on, which is a good thing too. We don't want it to become overheated like it's been the past 2 years.
Well, so to pile on to your point here, so a couple years ago, uh, my partner Ian, he held an event in Philly. It was called Market Makers, and there was some really really big players in the Philly market. One of which was a guy by the name of Richard Aller, who was a billionaire investor and he owns large multi units across the country, and specifically in Philly and Detroit and things like that. His number one criteria when evaluating a property to make an offer is what his finance terms were going to look like. How long can he push out low rates and how low can he get the rates? And based on those numbers, that was the jumping off point to value add construction, to, cash flowing the asset, to valuing the property itself. And it's kind of interesting how, that has affected if when you're looking at a commercial property, it's all about cash flow. It's all about what do the leases say, what's the consistency of payments, and and based on that, we can extrapolate a value out of it. And when those interest rates change, it has a real impact on the bottom line. But anyway,
Yeah, that's funny. That's funny. It's in real estate, we always talk about own nothing, control everything, and we talk about how you want your LLCs to own stuff and how and buying with both hands in bad markets.
yeah,
Sounds like that guy actually did it. And when
it's
you
insane.
when you begin and end with the ability to capture in mind and say real estate's going to go up in value, how can I control as much as possible? How can I capture as much as possible? Kind of worry about the rest second. Not don't worry about the rest, but worry
Sure.
about it after I figure out, can I finance it? How can I finance it? What's the most favorable finance terms I can get? Okay, then what, kind of what comes next with it?
Sure.
That's an interesting way of looking at things.
Yeah, yeah, and you got to learn how to value things, and I think that's where we come to at this point while when we're looking at interest rates and we're looking at home values. Certainly, there is a large segment of the population towards the median home price and below that their whole evaluation is monthly payment, and an increase of 1 or 2 or 5%, if we if they're walking into a 1980 to 89 average interest rate, they're not going to be able to afford that 1082 a month, right? Um, they might not be able to afford 482 a month, but they can get 452, and like that $30 might be the difference for a specific asset, or could be the difference maker. It doesn't sound like much, but it can, it can
Yeah, and
tip the
it's not
scales.
necessarily that it's much for any one person, but when you have everybody's buying costs go up, it just
Right.
sucks that much more money out of the economy. It's that much
Yeah.
more money that's not going to Kentucky Fried Chicken or car washes or, ballet lessons.
Yep.
It interest rates going up pulls money out of the economy.
Yep. Exactly. We'll move on here. I got a little pup in the background who
I was
thinks
gonna
that
say,
we're
is
not
that
on
a,
live TV. So
little doggy you got over
uh,
there?
that's right. I need 1 second here. You want to jump into short term
Yeah, absolutely. So
immediate
I think
impact
that
here? Okay.
yeah, absolutely. I think one of the things that you see when you look at the cost of financing isn't just what the costs are, but it's also how difficult the money is to get. And there's interest rates going up, but there's overlays that can go up as well.
Yeah.
And one of the overlays that we've seen recently increase significantly is second home underwriting guidelines. And second home underwriting guidelines is something that sometimes a second home is treated exactly as a primary residence.
Yep.
So if the money and the ease of getting your primary residence is here, and the cost and difficulty and everything like that of buying an investment property is up here, usually buying a second home is like right here. It's not halfway. It's
Right.
it's 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 not even a quarter of the way there. It's like a tenth harder. It's like a tenth the gap between investment property and primary residence is that second home. Well,
You know what?
what we're seeing right now is second homes are becoming more difficult, and that is going to help pull some of the wind out of the sails of the housing market, so that things don't get too overinflated. We're also seeing that as a response to a lot of second homes are actually being treated like investment properties. With the increase of short-term rentals and Airbnbs and things like that, a lot of people are buying second homes that aren't really a second home. They're
Well,
not
and
the intention isn't to use it as a second home. The intention is to use it as an investment property that you'll also get some owner use out of. But if it's being bought as an investment property, it's going to perform like an investment property. And it's going to default like an investment property. And so therefore, when something defaults like an investment property, um, you're going to want to underwrite it that way, and that's why it's important to price it out interest rate wise.
Judah, what's the most the number one reason why people don't pay their mortgage?
They run out of money.
They don't have the money, right?
Right.
That's the reason. That's why people don't pay their bills. Okay. So if you have a second property, you're not living there, and things start getting tight, what's the first thing that you're probably going to shed? It's
Right.
probably that investment property, right? Or not investment property, the second home,
Second. Right.
which is more of a risk a lot of
Right.
times than the investment property that you've got at least some income coming in. And usually, if a bank is going to underwrite you for an investment property, they're going to be looking at the income that's coming in on that property after the first year, or make sure that you can afford it for a year or two, whatever. So, I mean, looking at this, it's not really surprising that second home, the cost of that second home went up. I wonder what the difference though in the default rate is. I'm just looking right now. I'm wondering what kind of percentages of how much of an increase is that default as compared to a primary residence.
Well, and who knows what the difference actually is in the historical default rate or the trailing 24-month default rate is.
Yeah,
I think the reason we see the increase in the overlay being put on there
yeah.
is because bankers don't want to be caught after the fact, after there's a spike in default, and regulators and Congress and the public says, why were you treating second homes so much like primary residences when clearly that's not what was going on?
So
So
one of the
I think they're trying to predict the future a little bit, which is they're which is what a mortgage is. It's a future on that property. It's a bank saying, yes, I'll lend you money based on the future performance of you and the future performance of this asset.
Well, part of it too, I think, is that last April, Fannie Mae came out and said, look, their portfolio can't be more than 7%, and I wonder how much of that is full. I mean, how much of their portfolio are they currently sitting on? And with a lot of these overlays and the increase in interest rates, I think a lot of that is on face value, it's hey, we don't have as much bandwidth as maybe we once did. So if you're going to apply for these loans, you're going to pay a little bit more. But I think you're right. I think they're forecasting and saying, okay, let's get rid of the risk as much as we can. Let's downshift as we start looking at potential for some changes in the housing market, because we have to tighten the amount of money in the system and increase interest rates and all that kind of stuff. One thing that I thought was really interesting, and I think it's pretty indicative of the immediate future, is a spike in mortgage applications. I read an article just the other day. I want to say it's like 1.8 million, or it's either 1.8 or 18 million. 18 million sounds pretty high. Right. So it was a large percentage of new mortgage applications that were coming in. And I think people that have been kind of sitting on the sideline waiting for the housing market to loosen up, now they're looking at this and saying, hey, if I don't get in now, I might be at a 5.5% mortgage rate. And what does that look like? Even if there is a reduction in housing costs, like where am I at? So I think that, what we have is an influx of buyers that have been on the sideline. We still have this repressed inventory that has been going on. But we also have, right down the road to be announced in March and probably implemented in April, May, June, we've got interest rate hikes. So what we have in the short term, probably through the spring market, I think is we have an uptick in home prices. I think there's more competition for the houses that hit the market. I think they sell for more than they did a year ago. Even though the interest rates are a little bit higher, and certainly that's going to be limited to median and above home prices, the houses that everybody wants to live in a given market. But I think that's really where we're headed, with the anticipation that it's very likely that towards the end of this year, or even by June, we're going to have significantly higher interest rates, maybe to the tune of 1 or 2 percentage points, which is going to, I think, put the brakes on the housing market mid to late this year. And we could see some changes.
Yeah. So here's a crazy stat. I just checked Bright MLS. In all of Lancaster County, there's 290 houses currently listed for sale.
Yeah. Yeah.
Now, you're there in Lebanon County, and it's going to be much smaller just because it's a much smaller county. 75 houses.
Well, here's what's
Lebanon
really nuts.
County, there are
Lebanon's, yeah.
What's that?
Our area has been identified as one of the top 5 areas in the country to invest right now, between York and Hanover, between Lancaster and the city of Lebanon. There's a lot of people betting on a lot of good things, and I think that we've seen it in the transition of the demographics, not just over the last, not just since COVID, but maybe over the last decade. I just realized it when, kind of looking at through the prism of school sizes. When I was growing up, 25 years ago, most of the schools in central Pennsylvania were AA schools, which means they're small schools on the state, grand scheme of things in the state. Now, the vast majority of those same schools have grown in population and size to the point where now they're large schools. And I think that's an interesting, interesting analysis of what's happened. I think people really enjoy a lot of the open feel and the pretty fast transportation here in central PA that you really don't have in metro areas.
Let me make a couple points here. So in Lancaster County, 290 homes. That's it on the market. In Lebanon County, 75 homes. If we were to look at Lebanon, if we were to look at Berks and York and Dauphin and Cumberland counties, they're similar, very, very depressed. And here's the thing: of those 290 homes, if we were actually to pull it up for Lancaster County, I betcha about 50 of them are actually a vacant lot that they listed as if it's a house with a spec, as if it's a spec built house, and just to try and get somebody to take action there. They're what's called phantom lots. They're calling them. So there is a super depressed market for listings, and I tell you, your story there, what you're seeing in Lebanon. Do you know my boy Ari? Who he owns the Bell Building there in Lebanon, and we've done a number of deals together. He's a really sharp cat. And Ari, he has been big on Lebanon for a long time. And I posted something on his Facebook page just last night. I said, dude, you're exactly right. Like, I've been telling anybody who will listen, for the next 10 to 15 years, I would buy and hold in Lebanon because of where we've seen Lancaster has almost priced itself out of the development game. York and Harrisburg are not far behind. So if you were a developer and you wanted to build a 200, town, if you wanted to build like a 200 lot development, you'd go to Lebanon to do that. Like, there's much more room for expansion and room for growth and room for building and room for development in Lebanon than there is in a lot of these other places. And then what happens then is jobs and other things like that follow the people. And I really just see a whole lot of very aggressive potential growth in Lebanon. I'm very bullish on the area, and I think that people should buy with both hands in the Lebanon market.
I want to go back to Lancaster a minute, though.
Yeah.
So one thing that Lancaster has that a lot of central PA does not, excluding maybe Cumberland County and on the West Shore, there's a big void of big city feel. And, like a 40-minute drive to Lancaster for me is kind of a pain, but it's worth it when there's Wegmans and you've got like really great shopping there and you've got Whole Foods and you got a bunch of other stuff and people will pay for that. And I think Lancaster is still an undervalued city, even though it seems expensive and there's areas that, it's real tough to flip a house in because you're buying a shell for near market value. I think Lancaster is still a great place to invest. I think there's a lot of upside to it, and I think it's going to continue to grow for the next several years, especially since some of the zoning things that they've done outside of Lancaster. So, like when you have these farms that are no longer zoned for farming, so that when they transition ownership, it's going to be huge development, and
Right.
like they're planning for continued growth for years to come, and I think that is going to play a really great part. But I agree with you with Lebanon. I mean, I've seen a lot of great changes, and suburban Lebanon's awesome. Even in the city, there's a lot of great things happening, so it's good stuff.
All right, well, ladies and gentlemen, our time is up. Josh and I are here every Thursday at noon, where we want to talk about real estate topics, real estate investing. Please check us out and give us a like and share. Let me just say that ubiquitous comment that so many people do, and also let us know what show topics are of interest to you, because
That's right.
Josh and I aren't here preaching. We're here to deliver the value that you want and the content that you want. So we're not here to tell you what we think our take is or what we think you need to know. Let us know what you guys are looking at. Thanks, Matt, for the comment on good content. We certainly appreciate you, my friend.
That's right.
Ladies and gentlemen, we will see you next week. And until then, have a great day.
Awesome, guys. See you next week. Go make some money, and we'll talk to you next week. Thanks, guys. Take care.